Welcome to the Deep Dive. Today we're cracking open a topic that is absolutely fundamental to the functioning of any nation, and specifically today, India. Government finances. We're peeling back the layers on how a massive economy like India raises money and makes the complex decisions about where to spend it.
It really is the engine room of public policy, isn't it? And economic management. Often, when people hear government finances or the budget, their eyes just glaze over. It sounds so dry.
Oh, totally. Impenetrable jargon, endless numbers.
Right. But beneath the surface, it's actually about national priorities. It's about growth, welfare, and just the practical realities of keeping a country running. We've got a stack of sources here, quite detailed material, specifically looking at the Indian government's financial policies and practices.
And our aim with this deep dive is to kind of translate that density for you. Think of this as your essential briefing, a way to get quickly up to speed on the nuts and bolts. We're going to guide you through these sources, pull out the most important insights, maybe highlight some surprising facts.
And connect it all back to what it actually means in the real world for you.
Exactly. Our mission today: take a deep dive into these sources and extract the crucial insights on how the Indian government earns and spends its money. Let's unpack this. Okay, let's start right at the very foundation. When we talk about government finances in a country like India, what are the core objectives? Based on the sources we're using, what is the government actually trying to achieve with all this?
Well, the sources lay out a few key goals. At its heart, government finance is about making sure that public spending lines up with the nation's priorities. This isn't just random spending. It's supposed to be directed towards boosting overall economic growth and, critically, promoting the welfare of the people. So you've got growth and citizen welfare as sort of twin pillars.
Okay, strategic spending, got it.
Yep.
But there have to be constraints, right? It can't just be spend, spend, spend.
Oh, absolutely. A major objective is ensuring that all this government spending doesn't end up causing prices to skyrocket, basically, keeping inflation in check. It's a constant balancing act. Spend enough to stimulate the economy and provide services, but not so much that things overheat and everyone's money buys less.
And efficiency must be a goal, too. Getting bang for your buck, so to speak.
Yes, a vital one. The resources raised and spent need to be handled effectively. The sources explicitly mention avoiding wasteful expenditure. Public funds should be used to get the maximum possible impact.
Makes sense. Now, looking at the other side, how the government gets its money, the sources mention something important about revenue, especially taxes.
Yes, on the revenue side, the idea is that raising money, particularly through taxes, shouldn't put an unfair or, crushing burden on the average person. Taxation, they note, should be just.
Just taxation.
Yeah.
And it's also meant to help reduce income inequalities. So the tax system isn't just about filling the government's bank account.
Exactly. It's also seen as a tool, potentially, to help redistribute wealth a bit and promote more equity in society.
So bringing all that together,
Yeah.
the ultimate goal seems to be improving the overall welfare of the entire economy.
That's the big picture, yes. You've got growth, stability, efficiency, fairness, and overall well-being all woven into the purpose of government finances.
Now, what's really interesting, and maybe a bit surprising based on these sources, is that India doesn't actually have one single formal document called fiscal policy.
That's right. Instead, these big fiscal goals and policies are pursued and kind of laid out primarily through the annual financial statement presented to Parliament, what everyone commonly calls the union budget.
So the budget isn't just a list of income and expenses like my household budget.
Not at all. The sources really stress that the budget is a vital policy tool. It's the main mechanism the government uses to try and achieve those ambitious goals: growth, welfare, stability, fairness. It's more like an economic blueprint than just a balance sheet.
Okay, this leads to a really fundamental question then. How does this government budget, with these big objectives and this structure, actually differ from something more familiar, like how you or I might manage our personal finances?
That's a critical distinction the sources make. In personal finance, you typically start with your income, right? How much money do you have coming in? And then your spending decisions are basically constrained by that income, plus maybe what you can responsibly borrow.
Right. My income dictates my spending limits, more or less.
Exactly. The government budget, though, often works the other way around. The sources explain that expenditure is frequently considered first. The spending levels are often set based on what are seen as the country's needs and priorities. Defense spending, funding essential social programs, building major infrastructure, paying interest on past debt, things like that.
So the spending target is driven by national needs.
Yeah.
And that comes before they figure out exactly how to pay for it all.
Precisely. The need for a certain level of public spending based on these priorities then kind of dictates how they'll raise the money, whether that means trying to collect more taxes, borrowing heavily from the market, or using other income sources. This fundamental difference means that, by its very nature as described here, a government budget is often deficit-oriented. Planned spending regularly goes beyond the expected regular income.
So unlike a household that might aim for a surplus or at least break even, a government running a deficit isn't automatically a sign of failure.
Not necessarily from this perspective. In fact, the sources suggest that trying too hard to run a surplus or drastically cutting spending just to match current income could actually harm economic growth. It would reduce public spending, which is often a key driver of activity.
And given some of the inflexible costs the government have.
Right. Which we'll get into. Cutting spending to match receipts might mean hitting productive investments or essential social services hardest.
That makes sense. If the government isn't investing or supporting public services, the economy and people's well-being could suffer, even if the books look balanced on paper.
It really underscores that government finances are viewed through a much broader macroeconomic lens, aimed at managing the whole economy and society, not just optimizing one specific ledger like you would with personal money.
Okay, with that foundational understanding, the objectives, the deficit nature, let's zoom in on where the money actually goes. Public expenditure. Our sources detail how the central government spends its funds.
And until fairly recently, up to the financial year 2016-17, the budget used a specific classification system: plan and non-plan expenditure.
Let's break down that old system first. What was planned expenditure?
Planned expenditure was directly linked to the 5-year plans, which were a big part of India's economic planning for decades. This spending was earmarked for investment in specific priority areas identified in those plans. It could be planned capital expenditure, creating new assets like power plants or highways, or planned revenue expenditure, which cover the recurring costs like salaries for running those plan schemes.
And capital expenditure is seen as particularly important for growth.
Yes, the sources emphasize that capital spending, whether plan or non-plan, is generally desirable because it creates productive assets that boost the economy's long-term capacity.
Got it. So plan was tied to those big 5-year blueprints.
Yeah.
What about non-plan expenditure then?
Non-plan was basically everything else, all the other recurring spending the government had to do that wasn't specifically part of a 5-year plan. Think of essential, committed expenses needed just to keep the government running and meet ongoing obligations. Like planned spending, it could also be revenue or capital, but most of it was revenue.
Okay, and what's really eye-opening here, according to the sources, is the proportion. How much was plan versus non-plan?
It is striking. Non-plan expenditure actually dominated the budget. It accounted for a massive 70% of total government spending. Plan expenditure was only about 30%.
70%.
Yeah. And digging a bit deeper, within that huge non-plan category, the single largest component was non-plan revenue expenditure. That made up an enormous 63% of the total expenditure.
Wow. So almost 2/3 of all government spending was on these recurring, non-plan, non-asset creating costs. What exactly falls into that huge bucket?
The sources list the key components, and this really shows you the inflexible nature of a lot of government spending. The biggest single item, interest payments, just the cost of servicing the government's accumulated debt, both domestic and foreign. This alone ate up over 25% of the total government expenditure.
A quarter of the entire budget just paying interest. That's huge.
It really is. It highlights the long shadow that past borrowing casts on current spending capacity. Other major items included subsidies, big spends on things like food, fertilizers, and previously fuel to support certain sectors or keep prices down.
Okay.
Then there's establishment expenses for defense salaries, maintenance, running costs for the armed forces. Also, loans given to state governments and union territories.
Right.
And the establishment expenses of the central government itself, the cost of running ministries, departments, paying salaries, pensions. And speaking of pensions, pensions for retired defense and central government personnel were another large chunk.
So it's a mix of debt servicing, welfare support via subsidies, defense costs, transfers to states, and the government's own running costs.
Exactly. Those categories together accounted for over 90% of that massive non-plan revenue expenditure. And the source actually calls this kind of spending the consumption of the government.
Consumption, by that term.
Because unlike capital spending, which builds things like roads or factories, tangible assets that help future production, these expenses mostly cover current needs and operations. They don't create new, durable, productive capacity in the same way.
Okay, so connecting this back, the fact that such a huge proportion of spending was this consumption-oriented, non-planned revenue type, especially inflexible things like interest and subsidies, must have posed a real challenge.
A huge challenge. When the government wants to control overall spending or reduce the deficit or, critically, shift more money towards building assets through capital spending, these large, locked-in revenue costs are major roadblocks. They just consume a vast amount of resources.
It's a constant budget battle, trying to balance essential recurring costs with the need for future investment.
Absolutely. That tension is always there.
Now, the sources discuss a pretty significant change that happened relatively recently to this whole classification system.
Yes. Starting from the financial year 2017-18, the government basically ditched the old plan-on-plan distinction. Expenditure is now classified much more simply as either capital expenditure or revenue expenditure.
And this change was linked to bigger shifts in India's planning approach.
It was. The source connects it to the dismantling of the old Planning Commission, which oversaw the 5-year plans, and the end of that whole 5-year plan system. Now there's more of a medium to long-term planning framework under the NITI Aayog.
So the old labels just didn't fit anymore.
That's part of it. But the source also notes that many economists had argued for getting rid of the plan-on-plan split for a long time anyway. Their point was that the focus should really be on the quality of the spending and the end use. Is it creating an asset or covering a recurring cost, rather than this somewhat arbitrary plan-on-plan label?
What specific problems did that old system create? Why the push for change?
Several issues are mentioned. It apparently led to a fragmented view of how resources were allocated across different schemes, and crucially, it made it really difficult to figure out the true cost of delivering a public service, or to effectively link the budget outlays, the money allocated, to the actual outcomes, what was achieved on the ground.
So you couldn't easily tell if spending more actually led to better results.
Exactly. The label didn't tell you much about the impact. Another issue was a kind of bias, both at the central and state levels, towards favoring plan expenditure because it sounded more like development. This sometimes meant that essential non-plan costs, like maintaining the infrastructure built under a plan or the staff needed to run social services started under a plan, got neglected.
Like building a shiny new school, but not funding the teachers or upkeep properly.
Precisely that kind of problem. So the merger into just capital and revenue is expected to provide a much clearer framework. By focusing directly on whether spending creates assets, capital, or covers operations, revenue, it aligns spending more clearly with its economic purpose and hopefully leads to more focus and effective use of public money.
Okay, that's a really helpful breakdown of where the money goes. Now, let's switch gears completely and look at how the government gets the money to cover all this spending. The government receipts side of the equation.
Right. And the sources categorize government receipts into two main types: revenue receipts and capital receipts.
How do they differ? What's the key distinction?
Revenue receipts are basically the government's regular recurring income. They tend to be fairly predictable. They don't create a liability, meaning the government doesn't have to pay them back later, and they aren't borrowings. Think of them like the government's steady paycheck. The main examples are taxes, dividends from companies the government owns, PSUs, and interest it receives on loans it has given out.
Okay, so steady income, no added debt. What about capital receipts?
Capital receipts are different. They either do create a liability for the government, like when it borrows money by issuing bonds, or they are less regular and certain, like recovering loans it previously gave out or receiving grants. Selling off government assets, like through disinvestment, would also fall under capital receipts because it's usually a one-off thing.
And looking at the proportions here, the sources mention something pretty significant about which type dominates.
They do. About 90% of the government's total receipts come from revenue receipts. Only around 10% are capital receipts. This really highlights how heavily the government relies on those regular income streams, especially taxes, to fund its activities day to day.
And the absolute backbone of those revenue receipts is tax revenue, right?
Absolutely. Tax revenue accounts for a huge 84% of total revenue receipts, making it by far the most important source of government funding.
Taxes themselves are then divided into two broad categories, direct and indirect. How do we tell them apart?
The sources give a clear distinction. A direct tax is levied directly on a specific person or entity, like you paying income tax or a company paying corporate tax. You are identified and you are legally required to pay. The crucial point is that the burden, the actual financial hit, generally can't be shifted to someone else. You pay it.
So the impact falls squarely on the taxpayer named.
Exactly. An indirect tax, on the other hand, is levied on goods or services. While a business, like a shop or manufacturer, might collect the tax and pay it to the government, they typically pass that cost on to the final consumer by including it in the price. You pay it indirectly when you buy something. The tax authority doesn't necessarily know who ultimately bore the burden, and the tax is shifted along the chain.
And common examples mentioned for indirect taxes.
Things like excise duty on manufacturing, customs duty on imports, the old service tax, sales tax, octroi, municipal taxes, road tax, those sorts of things that get added to the price of goods and services. Of course, many of these were subsumed under GST later.
And what about the split in total tax revenue between these two types? Is it roughly even?
According to the source, it's around 55% from direct taxes and 45% from indirect taxes. So a slight tilt towards direct taxes, but indirect taxes still make up a very significant chunk of revenue. The sources also note indirect taxes are mostly based on value, ad valorem.
Now, India has a federal system. How does the power to levy and collect these different taxes get divided between the central government and the state governments?
It's a shared system reflecting the Constitution. The central government levies and collects major taxes like income tax, customs duty, the old central excise duty, and service tax. They handle the whole process for these big ones.
Are there taxes where the center levies it but the states actually collect the money?
Yes, the source mentions central sales tax, CST, on interstate trade. The center levied it, but the state where the sale originated collected it.
And then there are taxes that are purely the domain of the state governments.
Correct. Things like sales tax on sales within a state, pre-VA GST, octroi, various municipal taxes, road tax, entertainment tax, and importantly, agriculture tax. This division reflects the powers given to states.
And the crucial mechanism on sharing the money collected by the center from certain taxes with the states. How is that decided?
That's the job of the Finance Commission. It's a constitutional body set up periodically. The source mentions the 13th Finance Commission, headed by Shri Vijay Khokar, whose recommendations covered the period 2010-2015. They recommend the formula for dividing up the central tax pool between the center and the states, and also among the states themselves.
Beyond the main taxes, the source mentions two extra types of levies, surcharge and cess. What's the difference there?
They're both additional charges on top of an existing tax. A surcharge is basically an extra percentage calculated on the amount of tax you owe. So if your tax is 100 and there's a 10% surcharge, you pay an extra 10 more. The money raised generally goes into the government's general pot for any purpose.
Okay, a tax on tax for general revenue. How is a cess different?
A cess is different because the money collected from it is specifically earmarked for a particular purpose. The source gives the example of an education cess that money has to be spent only on education initiatives. It can't be used for, say, building roads. That earmarking is the key distinction.
Got it. Apart from taxes, other revenue receipts include dividends from PSUs and interest from states. Capital receipts include loan recoveries, grants, and borrowings.
That's the mix.
Now, here's where it gets really interesting from a practical standpoint. Managing the cash flow. Government spending happens continuously, salaries, pensions, project payments. But receipts, especially big ones like direct taxes, that only come in quarterly.
Absolutely. This creates temporary mismatches. You have bills to pay today, but a big chunk of your income isn't due until next month. The government needs a way to bridge these short-term gaps.
And the Reserve Bank of India steps in here.
Yes, the RBI, as the central bank, provides a facility called Ways and Means Advances, or WMA. It's essentially a temporary overdraft facility for the central and state governments to manage these timing differences between inflows and outflows.
Is it unlimited, or are there restrictions?
Oh, there are definite limits. The sources mention specific limits for the central government, for example, 20,000 crores during the first half of the year and 6,000 crores in the second half. And critically, it's very short term. The advance has to be repaid within a maximum of 90 days. It really highlights the day-to-day practicalities of managing the government's massive cash flow.
Okay, so that covers where the money comes from, mainly taxes, some capital receipts, and temporary bridging loans.
Yeah.
Now we bring the two sides together, expenditure and receipts. When spending is higher than receipts, we get a deficit.
Exactly. A budget can be in deficit, spending receipts, surplus receipt spending, or balance spending receipts.
And as we established earlier, the way government budgets are often structured, focusing on needs first, means they're typically deficit-oriented.
That's the tendency, yes. The pressure to fund development, welfare, defense, and other priorities often pushes planned spending beyond regular income.
And trying to force a balanced budget by slashing spending could actually be bad for the economy.
It could, particularly if it means cutting back on productive investment or essential services, especially given those large, inflexible costs like interest payments we talked about. Cutting might hit the wrong areas.
So a balanced budget isn't necessarily the holy grail from an economic policy view.
Not always. Purely as accounting, it looks tidy. But the source mentions the balanced budget multiplier concept, which suggests that even if you increase spending and taxes by the same amount, keeping the budget balanced, it can still stimulate the economy. So growing both modestly might be better than keeping both static.
Interesting. Now, the sources get very specific about how deficits are measured. There isn't just one deficit number. Let's look at the different types they explain.
Right. First, they mentioned the budgetary deficit, which was simply total receipts minus total expenditure. But they note this measure isn't really used anymore in India. The focus shifted to the fiscal deficit.
Okay, so budgetary deficit is mostly historical now. The key one is the fiscal deficit. How is that calculated?
Fiscal deficit is total expenditure minus total receipts, excluding government market borrowings. Since borrowing from the market is the main way the government funds the gap, this figure essentially tells you the total amount the government needs to borrow from the market in that year. That's the headline number everyone watches.
Fiscal deficit, total market borrowing need. Got it. What about the revenue deficit?
Revenue deficit is calculated specifically as revenue expenditure minus revenue receipts. It just looks at the shortfall on the regular day-to-day side of the budget, the gap between recurring spending and recurring income.
And the sources flag this one as potentially the most dangerous type of deficit. Why is that?
Because it means the government is borrowing money just to cover its ongoing consumption expenses, things like salaries, subsidies, interest payments. It's not borrowing to build assets like roads or ports that might generate future income or boost growth to help repay the debt later. Borrowing for investment can be justified, but borrowing just to pay the monthly bills means accumulating debt without building the capacity to service it.
It's like using a credit card to pay your rent versus using a loan to invest in education or a business. One builds future capacity, the other just covers current spending while adding debt.
That's a good analogy. And the source gives a pretty stark figure for India. Around 70% of the fiscal deficit was accounted for by this revenue deficit. This highlights a major structural issue. A large chunk of the government's borrowing was going towards covering consumption, not creating assets.
That really drives home the challenge posed by that large non-planned revenue expenditure we discussed earlier. Okay, what's the fourth type of deficit mentioned?
The primary deficit, this is calculated as the fiscal deficit minus the interest payments for that year.
What does taking out interest payments tell us?
It helps isolate the impact of past debt on the current year's deficit. It shows what the deficit would be if the government didn't have any interest obligations from previous borrowing. A high primary deficit suggests that even without interest costs, current spending is way above current income, pointing to issues in this year's fiscal management. A low primary deficit, which the source says is the case in India, indicates that the high fiscal deficit is significantly driven by the unavoidable burden of paying interest on past debt.
So in India's case, the low primary deficit means a big reason for current borrowing is simply to pay the interest bill on loans taken out years ago.
That's the implication, yes. A significant portion of new borrowing is needed just to service old debt. Now, while deficits are often structurally necessary for governments, the sources stress that too much deficit is bad, mainly because it can fuel inflation if it leads to excess money creation without a corresponding increase in goods and services.
Is there a rule of thumb for a safe level of fiscal deficit?
The source mentions a commonly cited benchmark. Ideally, keeping the fiscal deficit below 3% of GDP, perhaps considered alongside the balanced budget multiplier effect. However, it immediately acknowledges how difficult this is in practice, given the government's essential responsibilities for welfare, infrastructure, and so on.
Which brings us back to that core challenge. How does a government balance funding these absolutely vital things, supporting millions of people, building a modern economy, with the need to control borrowing and deficits, especially when past debt is already driving up current borrowing needs? Seems incredibly tricky.
It's arguably the central dilemma in public finance. Recognizing this tension, the government enacted the Fiscal Responsibility and Budget Management Act, the FRBMA.
Right. What was the FRBMA designed to do? What targets did it set?
It aimed to impose some legislative discipline on government finances. It set specific targets for gradually reducing both the revenue deficit and the fiscal deficit over time. The goal was to bring the revenue deficit down to zero by 2007-08 and to steadily reduce the fiscal deficit each year, starting from 2004-05.
Those sound like ambitious targets. Were they met?
The source is quite clear. No, those targets were not achieved within the original time frame.
And what's fascinating here is how real-world events can intervene. The source notes the global financial crisis around 2007-2008 led to a conscious policy decision.
Yes. To counter the economic slowdown threatening India in the wake of the global crisis, the government decided to implement a fiscal stimulus, basically, increase government spending to support demand. This meant consciously relaxing the FRBMA targets for a period. It shows that in a severe crisis, counter-cyclical policy spending more, even if deficits rise, can sometimes take precedence over long-term fiscal consolidation goals to stabilize the immediate situation.
A clear example of theory versus messy reality. So if controlling expenditure is tough due to essential commitments and past debt and deficits need managing, a major lever the government has is trying to increase its receipts. Which brings us squarely to tax reforms, since taxes are the main income source.
Exactly. The sources emphasize the need to increase the tax-to-GDP ratio. The figure mentioned was around 10%, which is often considered low for a developing economy. The argument is simple. As the economy grows, tax revenue should ideally grow even faster, leading to a higher ratio. If it stays flat, it suggests problems with the tax system's efficiency or compliance.
Let's dig into those tax reforms, starting with indirect taxes. We know they contribute about 45% of revenue and are often seen as regressive.
Right, regressive meaning they hit lower income people harder as a percentage of their income. The source's example of excise duty on salt illustrates this perfectly. A fixed tax amount is a much bigger burden for someone poor than someone rich.
What were some of the other big problems with the old indirect tax system that reforms aim to fix?
Complexity was a major one. The sources mention multiple tax rates and structures, leading to confusion, disputes, and opportunities for evasion. But a huge issue was the cascading effect, the tax-on-tax problem.
Ah, yes, the Maruti MRF tire example. Can you walk us through that again?
Sure. MRF makes tires, pays excise duty. Maruti buys the tires. The price includes that duty. Maruti builds a car using the tires. Under the old system, the final car price, which already includes the tire cost plus the embedded tire duty, gets hit with excise duty again on the car's total value.
So tax is levied on a value that already contains a previous tax payment.
Exactly. This stacked up, inflating manufacturing costs, making products more expensive for consumers, and hurting competitiveness.
How did reforms try to tackle these issues?
For regressivity, they tried simplifying duty slabs and lowering rates on essential goods. But the main weapon against cascading, according to the sources, is value-added tax, or VAT.
And VAT works by taxing only the value added at each step.
Precisely. Instead of taxing the full price repeatedly, VAT lets businesses claim credit for the taxes they paid on their inputs. So the tax effectively only sticks to the new value created at that stage. It eliminates the tax-on-tax problem.
A major milestone mentioned was introducing VAT at the state level.
Yes, replacing the old, messy state sales tax systems. This rolled out from April 1st, 2005. The source credits Sri Asim Das Gupta for leading what it calls a Herculean effort.
Why Herculean? Why was it so hard to get states on board?
Because under the old system, sales tax rates for the same product could vary wildly from state to state. This created distortions. Businesses might locate factories based on tax rates, not efficiency. Getting all states to agree on a more uniform VAT system meant some states with high sales tax rates stood to lose revenue, at least initially. It required huge coordination and negotiation. The goal was one product, one rate across states for many goods.
What were the key features of state VAT once implemented?
It wasn't a brand new tax, but a new collection method, multi-stage with credit instead of single-point sales tax. The core was the set-off mechanism. Businesses could deduct VAT paid on inputs from VAT on outputs, using invoices as proof. There was an effort toward uniform rates, like 4% on mass goods, 12.5% on others. Small businesses below a turnover threshold were often exempt.
And did it work? What were the benefits?
The sources say yes. It helped curb evasion by encouraging a bill culture. You needed invoices for credit, creating a paper trail. It improved transparency. And importantly, it actually boosted revenue collection for state governments over time.
So building on state VAT, the next logical, massive step was the goods and services tax, or GST.
Yes, GST was envisioned as the ultimate indirect tax reform, merging most central and state indirect taxes on goods and services into a single unified tax. The idea was one comprehensive tax applied across the country, levied concurrently by both the center, CGST, and states, SGST, TGST, on sales within a state, and an integrated GST, IGST, by the center on sales between states.
That sounds like a huge simplification effort.
That was the main goal: create a common national market, remove tax barriers between states, eliminate cascading completely, broaden the tax base, and potentially allow for a lower overall tax rate that could reduce prices for consumers while still ensuring government revenue. It was pitched as a win-win-win.
The source details some of the specific benefits hoped for from GST.
Yeah, for businesses, lower compliance costs, no tax cascading making them more competitive, smoother flow of input tax credits improving cash flow. For the government, a wider tax base, better compliance thanks to the digital trail, potentially higher revenues, and improved ease of doing businesses rankings. And for consumers, hopefully lower prices due to efficiency gains and reduced cascading, plus greater transparency.
It's described as a destination-based consumption tax. What does that mean exactly?
It means the tax revenue ultimately goes to the state where the goods or services are consumed, not where they are produced. Although tax is collected at each stage, the input tax credit system ensures the net tax burden falls on the final consumer and the revenue accrues to the consuming state.
And technology was absolutely critical for making GST work.
Totally essential. The source calls GST largely technology-driven. The Goods and Services Tax Network, GSTN, a dedicated IT platform, was created to handle everything: registration, filing returns, payments, settling interstate taxes, analysis. The aim was to minimize human intervention and make it seamless.
What other key features of GST are mentioned?
The seamless flow of input tax credit, ITC, is central. Businesses get credit for taxes paid on inputs, including capital goods. There's the GST Council, a joint body of center and states, which is crucial for recommending rates and rules, ensuring cooperation. The National Anti-Profiteering Authority was set up to ensure businesses passed on tax cut benefits to consumers. Exports are zero-rated, meaning no GST applies, boosting competitiveness. Imports are taxed, IGST, to level the playing field with domestic goods.
That's a massive transformation on the indirect tax side. Let's switch now to direct tax reforms.
Okay. Direct taxes, income tax, corporate tax, make up about 55% of tax revenue. They're generally seen as more progressive.
Progressive meaning based on ability to pay. Higher income, higher tax rate.
Exactly. Income tax slabs mean wealthier individuals pay a larger percentage of their income in tax. This is considered fairer and also helps generate more revenue from those who can most afford it.
Now, here's where it gets really interesting. The source talks about something called fiscal drag that can happen with progressive income tax, especially when there's inflation.
Yes, fiscal drag. It's a bit counterintuitive. When inflation pushes up wages nominally, even if your actual purchasing power hasn't increased much, that higher nominal income can push you into a higher tax bracket.
So you end up paying a higher percentage of your income in tax just because of inflation, even if you don't feel any richer.
Precisely. Inflation drags you into a higher tax slab. This automatically increases government tax revenue without any change in tax rates, which is good for the government's books, but it can dampen individual spending power.
It's like a stealth tax increase hidden by inflation.
You could see it that way.
Yeah.
Now, a really striking point the source makes is about the number of people actually paying direct taxes in India.
And the number was surprisingly low.
Extremely low. At the time the source was written, only about 4% of the population, maybe 37 million people out of over a billion, were filing income tax returns. The source really stresses how low this is for a large, growing economy with an expanding middle class and, many wealthy individuals. The number of taxpayers wasn't growing nearly as fast as the economy or population.
That implies a huge gap between potential taxpayers and actual taxpayers.
That's the clear takeaway, which naturally leads to the question, how can the government increase the number of taxpayers and the amount of direct tax collected? The source looks at three main ways.
Okay, option one, increase the tax rate.
Seems obvious, right? Just raise the rates. But the source brings in the Laffer curve concept. The idea is that while raising rates from very low levels increases revenue, beyond a certain point, higher tax rates can actually reduce total tax revenue.
How does that work? Why would higher rates mean less money?
Because excessively high rates create strong incentives to not comply. People might work less, invest less, or crucially put more effort into hiding income or outright evasion. It fuels the black economy. The source suggests India was likely already on the wrong side of the Laffer curve, meaning further rate hikes would probably be counterproductive, leading to more evasion rather than more revenue.
Well, raising rates is seen as off the table. What's option two?
Increase the tax base. This means bringing more people or more income into the tax net. One way is to lower the basic income tax exemption, limit the income level below which you pay a zero tax. At the time, it was mentioned as 2.5 lakh per year.
Lowering that would mean more people have to file and potentially pay some tax.
Technically, yes. But the source argues that 2.5 lakh was already quite low, considering inflation and the rising costs of living, education, housing, transport, especially for the middle class.
So lowering it further would just squeeze the middle class more.
That's the concern raised. You might increase the number of filers, but many would be paying very little tax, so the overall revenue boost might not be that significant. The other way to increase the base is to tax sectors currently outside the net. The main one mentioned is agriculture. But agricultural income is constitutionally a state subject, so the central government can't directly tax it.
Okay, so significantly widening the tax base also looks difficult for the central government.
Based on these sources, yes, raising rates seems counterproductive, and substantially expanding the base faces practical and constitutional hurdles.
Which leads to the third approach, identified by the source as the major problem area: ensure tax compliance.
This is the big one. It's about making sure that everyone who should be paying taxes under the existing laws is actually paying the correct amount. The source points directly to a lot of leakages, large-scale tax evasion, and black money as the core issue holding back direct tax collection.
And the estimate given for the scale of this black money is staggering.
It really is. The source suggests over 40% of India's GDP could be black money income circulating entirely outside the tax system. Think about that: nearly half the economy potentially untaxed. That represents an enormous loss of revenue and a fundamental challenge to the system's fairness and effectiveness.
Let's really dive into this black money issue then, since it's so central. What exactly is black money, according to these sources?
It's not literally black cash. It's defined as unaccounted income that hasn't been declared to the tax authorities. It might be earned illegally, but it can also come from perfectly legal activities where the income just isn't reported to dodge taxes. This money often gets used unproductively, maybe hoarded or spent lavishly, instead of being channeled into the formal economy. Tackling black money and tax evasion is presented as absolutely critical for improving compliance.
How does it typically get generated? What's the main mechanism?
The source points overwhelmingly to large cash transactions. Why? Because cash is hard to trace. When big sums change hands in cash, it's difficult for authorities to track where it came from or where it went. The examples given are stark. Receiving lakh in cash is flagged as inherently suspicious. Any large transaction, say over 10,000 in the example, done purely in cash, raises red flags.
So avoiding formal banking channels is key to keeping money black.
Absolutely. The source is very clear. Transactions not done via traceable methods, checks, bank transfers, digital payments are prime candidates for generating black money. If you deposit a huge amount of cash without a legitimate source, it's black. If you get the same amount via a check, it's white because there's a record. It really reinforces that the informal cash-based economy is where black money thrives.
What are the underlying reasons why people generate black money? What motivates it?
The sources list several factors: high tax rates and complex laws. We discussed this. They incentivize finding ways around the system. Excessive controls. Sometimes too much red tape on legitimate transactions pushes people towards informal cash methods. Prevalence of cash in certain sectors. Real estate is mentioned specifically, where large cash payments have historically been common. Lack of banking access. If people don't have bank accounts, they're forced to rely on cash. Need for illicit payments. Bribes, under-the-table payments for admissions, dowry, these often require untraceable cash. Social pressures. Sometimes lavish spending at weddings or functions, funded by cash. Social pressures, and of course, outright illegal activities generate inherently black income.
What steps has the government taken over time to try and curb this?
Historically, the source mentions things like voluntary disclosure schemes, offering amnesty to declare hidden income by paying a penalty, and previous demonetizations of very high-value notes like 5,000 and 10,000 notes, which were taken out of circulation earlier.
And more recently, before the really big move.
Efforts included restricting large cash transactions, like the 10,000 example, limiting how much cash banks could accept for making drafts, making PAN, permanent account number, mandatory for transactions above a certain value, like 50,000, and crucially, computerizing tax offices and creating networks to share data and track financial activities better. They also started requiring various entities, land registrars, credit card companies, car dealers, to report large transactions to the tax authorities. The idea was to create more data points and make it harder to hide. The proposed direct tax code was also hoped to simplify laws and plug loopholes.
But compliance remained the major bottleneck.
Yes.
Okay, here's where it gets really interesting. November 8, 2016, a date many remember, described in the source as a historic measure with profound implications.
Indeed. This was the sudden demonetization of the existing 500 and 100,000 currency notes. These were the workhorses of the cash economy, the most common high-value notes.
And they stopped being legal tender almost overnight.
Exactly. At one fell stroke, as the source puts it, about 86% of the cash by value circulating in India became invalid. People were given a limited time window until December 30th, 2016, to deposit these old notes into their bank accounts. At the same time, strict limits were placed on how much cash people could withdraw.
So it wasn't just about replacing notes, it severely restricted access to cash for a period.
Yes, it effectively limited the convertibility of bank deposits into physical cash. The stated aims were fourfold: tackle corruption, curb counterfeit currency, stop the use of these notes for funding terrorism, and the big one, attack the stock of black money held in the form of these high-value notes.
And this dramatic move came after several other anti-black money steps had already been taken.
Yes, the source lists them. Setting up the Special Investigative Team, SIT, the Black Money Act, the Benami Transactions Act, amendments, getting information sharing agreements with countries like Switzerland, revising tax treaties with places like Mauritius, and the income disclosure scheme just before demonetization. So demonetization was positioned as a major escalation, a signal of regime change regarding tolerance for black money. It was framed as a direct tax or penalty on illicit wealth held in cash.
How exactly did it work as a tax on black money holders?
Well, if you held large amounts of unaccounted cash in these old notes, you faced tough choices. One, deposit it. You'd have to explain the source. If you declared it as income, you'd pay tax, possibly with penalties. Two, don't deposit it. The notes become worthless paper. You lose 100% of its value, effectively 100% tax. Three, try to launder it. Maybe pay someone else a commission to deposit it for you, incurring a cost to make it white.
So it forced a reckoning for cash hoarders.
That was the intention. Beyond the direct hit on existing cash, it was also meant as a powerful signal against future tax evasion, showing the government was serious. It reportedly had significant public support, suggesting a societal shift against illicit wealth as well.
Was it also hoped to push the economy towards formality?
Yes, that was another major goal. By taking away the main cash denominations and restricting withdrawals, it strongly incentivized people and businesses to shift towards digital payments.
Yeah.
The source mentions the push for payment apps like BHM, mobile payments, Aadhaar-based systems, and incentivizing card machines, POS.
Digital transactions leave a trail, making tax evasion harder.
Exactly. Another potential benefit discussed was channeling informal savings into the formal banking system. Even if people eventually withdrew cash, some of the newly deposited money might stay in banks, increasing their deposit base.
And a larger deposit base could mean
More funds available for banks to lend out, potentially at lower interest rates, which could boost investment and growth. The long-term hope mentioned was that demonetization might permanently reduce the reliance on cash, lower cash to GDP ratio, increase formal financial savings, and thereby support long-run economic growth.
that was clearly a massive disruptive policy aimed squarely at black money and informality. Beyond such major interventions and compliance drives, what else do the sources suggest for improving the tax system overall?
They raise a really fundamental question. Why don't people in India generally take pride in paying taxes? Why isn't it seen more widely as a positive civic duty, like in some other countries?
And the suggested answer gets to the relationship between the citizen and the state.
It does. The source suggests it's partly due to a lack of trust, a perception that the government doesn't always use tax money effectively or productively for the benefit of ordinary people. If people doubt their money is being used well, they're less inclined to pay willingly.
So improving compliance isn't just about enforcement, it's also about building trust by showing responsible spending.
Absolutely. The source suggests several things needed. First, visible government austerity. Less lavish spending by officials, more responsiveness to public needs. If taxpayers see prudence, they might feel better about contributing.
Makes sense. What else?
Compliance needs to be top-driven. The source asks rhetorically if top politicians or bureaucrats are ever seen publicly filing their taxes. While not required, doing so would send a powerful, symbolic message, like when leaders vote first in elections.
Lead by example.
Exactly. Another idea. Publicly honor the highest taxpayers. Why not celebrate those who contribute significantly? It could create positive reinforcement.
And changing the image of the tax department itself.
Crucial. Shifting from a perception of suspicion, everyone's an evader, to one of support and service, may I help you, assisting taxpayers, making it easier to comply.
Even small gestures matter.
The source suggests things like sending a simple automated thank you note to taxpayers after they file, a small token of appreciation.
And finally, on the stick side of the equation.
The source describes policies against evasion as often being soft. It calls for strong, uniform punishment for evaders and black money generators, applied equally regardless of status, to act as a real deterrent.
So it's a mix. Stricter enforcement, better service, public recognition, government demonstrating responsible spending, and leading by example.
That's the multifaceted approach suggested. Beyond compliance, simplifying the tax regime itself is key. Low rates, few exemptions, easy enforcement, minimize opportunities and incentives for evasion.
The source uses the acronym BECN for an efficient tax system. What does that stand for?
Right, DECN, buoyancy. Tax revenue should grow automatically with the economy without needing rate hikes. Effectiveness. The system should actually work in getting people to comply. Cost effective. It shouldn't cost too much to collect the taxes. Lower collection cost is better, neutral. Ideally, taxes shouldn't distort economic decisions, like where to invest or what to buy.
And the moves towards GST and a potential direct tax code are seen as steps in this BECN direction.
Yes, aiming for simplification, buoyancy, better compliance. But the source adds another point. Keep an eye on the cost of tax collection itself. It needs to be efficient to collect more revenue at a lower administrative cost.
And going back to the expenditure side one last time, even with inflexible costs, is there still room to trim the fat?
The source argues yes. It suggests reviewing the sheer number of government ministries, maybe merging some, abolishing vacant posts that aren't really needed, and generally increasing austerity in government operations. Even small savings multiplied across the whole system can add up.
And the guiding principle here should be
economics should prevail over political compulsions. Decisions about spending and government structure should ideally be based on efficiency and fiscal prudence, not just political convenience.
okay, we've covered a lot. Objectives, spending, receipts, deficits, reforms, black money. Let's finally touch on the actual mechanics, the budgetary process itself, and some recent reforms to how it works.
The typical process starts with an economic review, often presented as the economic survey just before the budget, setting the scene.
Then the big day budget day.
Right. The finance minister presents the budget, usually detailing spending plans first, then moving to the tax proposals, which everyone watches closely.
And all the money collected goes into one central pot.
The Consolidated Fund of India. And constitutionally, money can only be withdrawn from this fund after Parliament approves the budget authorizing the spending.
Are there any exceptions where spending doesn't need Parliament's vote?
Yes, certain mandatory items are charged expenditure. Things like interest payments on government debt, salaries for top constitutional posts like the Chief Justice, KEG, CBC. These have to be paid, so they don't require a specific vote, though they are discussed.
The source also mentions other types of budget presentations.
Yes. An interim budget is used if a full year's budget can't be presented, usually because elections are coming up. It covers spending for part of the year.
And a vote on account. How is that different?
A vote on account is even more limited. It's purely seeking permission to cover ongoing, essential government expenses for a short period, typically the first few months of the financial year, when there's no time to pass even an interim budget, again, usually due to elections. Crucially, a vote on account contains no new spending proposals or tax changes. It's just to keep the lights on.
Just maintaining the status quo temporarily.
Exactly. And the Election Commission can actually restrict an outgoing government to only a vote on account if election dates are announced, to prevent them from trying to influence voters with last-minute spending promises.
Now, historically, the budget process was known for being quite secretive.
Yes, the source notes that tradition, but it argues for more transparency and public participation, saying budgets are of the people too.
Another criticism mentioned was the focus on outlays over outcomes.
This is a big one. Budgets traditionally detailed the outlays, how much money was allocated, but they often didn't clearly state the expected outcomes, what results were supposed to be achieved with that money. Just spending more doesn't guarantee better results. There's a need to link spending to performance.
Hard to judge effectiveness without knowing the goal.
Precisely.
Now, the sources highlight several major reforms to the budget process itself, implemented post-2016.
One huge change was merging the rail budget with the main union budget. This ended a 92-year practice of a separate railway budget.
So from 2017-18, railway finances are just part of the general budget.
Yes. There's still a separate discussion on railway spending, and the railways retain functional autonomy, but their finances are integrated. This shifts their deficit and capital spending burden to the finance ministry and ends the dividend they use to pay the government.
Who recommended this?
A committee led by Bibek de Broy. The idea was to help raise more capital for railway expansion, crucial for growth, and allow for more integrated national transport strategy.
Another big process change was moving the budget presentation date forward.
Yes, from the traditional last day of February to around February 1st.
What was the logic behind presenting it earlier?
The main goal was to get the entire budget approved by Parliament before the new financial year starts on April 1st.
So departments know their funding right from day one.
Exactly. Under the old system, approvals often dragged on, requiring that vote on account for the first few months. Advancing the date means the full budget is theoretically in place from April 1st, avoiding the vote on account, getting the finance bill, with tax changes passed earlier, giving certainty to departments and the private sector sooner.
Sounds like a significant improvement for planning and execution.
It was intended as such, yes, reportedly proposed by senior bureaucrats.
And the third major process change we already covered, getting rid of the plan-on-plan classification.
Correct. Switching to just capital and revenue expenditure from 2017-18 aimed at improving the quality and focus of spending by distinguishing asset creation from operational costs.
The source also suggests budgets sometimes get too lost in the weeds.
Yeah, the argument is that the main presentation should focus on the big picture, overall policy direction, major tax changes, broad spending priorities. Getting bogged down in tiny details about taxes on specific products can obscure the macro strategy. Maybe put the micro details in annexures.
So, reforming the process of government is just as important as reforming the policies.
That's a key point. Internal government efficiency matters hugely.
Finally, the source briefly mentions some other conceptual approaches to budgeting.
These are different methodologies governments might use. Zero-based budgeting, ZBB, means every expense has to be justified from scratch each year, not just based on last year's budget.
Start from zero every time. Sounds intense.
It is. Then there's an outcome budget, which tries to explicitly link spending allocations to the measurable results or outcomes expected from government programs.
Measuring performance.
Right. A gender budget isn't a separate budget, but an analysis of the main budget through a gender lens to see how policies affect men and women differently and promote equality.
And performance budgeting, or PPBS.
Planning, programming, budgeting system. It tries to tightly integrate budgeting with overall national planning, making resource allocation more systematic and focused on achieving planned objectives, with evaluation built in.
So these are different frameworks or tools to make budgeting potentially more effective, accountable, or targeted?
Exactly. They represent different ways of thinking about how to manage public money for better results.
So we've really taken a comprehensive deep dive into this complex world of government finances in India, guided by these sources. We've looked at the core objectives: growth, welfare, stability, efficiency, equity. We've seen how money is spent and the big shift from plan to capital revenue. We've examined how funds are collected, the roles of different taxes, and the revenue versus capital receipt distinction. We've grappled with deficits, fiscal, revenue, primary, and the challenge they pose. We explored major tax reforms like VAT and GST, the deep-seated issue of black money, and the impact of demonetization. And finally, we looked at the budget process itself and recent reforms.
Yeah, what really stands out is this constant balancing act, trying to meet the immense development and welfare needs of a huge nation, while managing debt, improving fiscal health, and creating a tax system that's effective and seen as fair. It's incredibly complex.
It's clear that government finance isn't just some abstract economic concept. It touches everyone's lives through taxes, public services, infrastructure, and the overall health of the economy.
Absolutely. The choices made have massive consequences.
Which leads to a final thought for you, our listeners, to maybe ponder. Given this inherent need for significant government spending on development and welfare, and the real challenges in controlling expenditure while dealing with things like a large informal economy and past debt, what do you think is the most critical area for the Indian government to focus on right now? Is it purely about enforcing tax compliance more strictly? Is it about finding smarter ways to spend the money they have? Is it about continuing to reform the tax base? Or is there another lever that's even more important for achieving both fiscal health and better lives for citizens simultaneously?
Definitely something to mull over as you go about your day.